Good morning, everybody. I'm glad you joined us here this morning. We've got, as you see, our panels entitled Macroeconomic Outlook, The Search for Value. And I'm fortunate enough to have a set of august panelists here that are going to show us and tell us exactly where that value might come from. But just maybe by way of lead-in, you know, the context is we're 10 years from the financial crisis. I think it's time to stop talking about post-financial crisis and time to start talking about how we sustain the recovery. The global recovery has been pretty muted, weak by most historical standards. But recently, just in the last year, it feels a little bit different. You might say led by the U.S. The U.S. economy has recovered nicely, even though GDP growth is still pretty stagnant-ish. Unemployment has come down. Inflation looks a little bit better. Even the Fed has started to lessen accommodation. So I'd say led by the U.S., but even if we were here a year ago in the developed markets, we would be cringing about Europe, the Eurozone, you know, continuing to grind down low growth, low inflation. The Eurozone, or at least the continent, looks a little bit better today. In spite of the political noise, which I'm sure we'll all talk about here today, Europe looks pretty good. Growth is trending up. The UK, and even Japan, the other major developed economy we talk about is Japan, and Japan is in a long, slow decline. With the global recovery, you're starting to even see a little bit of growth and prospects for improved outlook out of the Japanese environment. And then if I flip quickly to the other important half of the equation, the emerging markets, that story again looks quite different today than it did a year ago. A year ago, we talked about China. What's China growing at? It's going to fall off a cliff. China now, the conversation feels as though it's a little bit more stabilized. India, throughout this period, has done well. But then if you look at the other BRICS, Brazil and Russia probably came out of a trough, in my view, in 2016, looking to the upside. So if you put all that together, the environment does look quite a bit different in the last year. I would argue better. Having said that, you know, I don't know if there's more or less geopolitical risk in the world. It certainly feels more intense, whether it's the South China Seas or North Korea, what's going on in the Middle East, Russia. Again, we'll talk about that and how that influences a view of investing today. Against this backdrop, if you're an asset owner, you know, you're constantly looking at your investment allocation. I think in many of the asset owner world, taking down returns, expectations for returns, taking more risk perhaps on the portfolio. We'll get into that as well. So we've got, I would say, a great background and fodder for talking about where do you mine value today. And just by way of, you've got the full introductions in the book, so I'm not going to bore you with it, but I do want to just introduce the panelists. Afsaneh Beschloss, President and CEO of the Rock Creek Group, previously Managing Director of the Carlyle Group and Treasurer and Chief Investment Officer of the World Bank. Thanks for joining us, Afsaneh. To her left is Bjarne Larsen, who's the Chief Investment Officer of Ontario Teachers' Pension Plan. One of the largest, actually the largest single profession pension scheme in Canada, and he was previously CIO of Denmark's largest pension plan. So a lot of depth in global asset owner pension environments. And then to my left, to your right, Josh Harris, co-founder, member, board of directors of Apollo Global Management. We all know Apollo. My fun fact about Josh, he's also the managing member of the New Jersey Devils, the part owner of the Philadelphia 76ers, and general partner of the Crystal Palace Football Club. So diversified in many ways. If you have sports questions, he's the guy. And then to Josh's right is Tony James, who's the President and Chief Operating Officer of Blackstone Group, member of Board of Directors, and of course we all know Blackstone Group as a very global and very dispersed alternative investment provider. So I thought we'd get right at it. And maybe I'll start with Afsaneh. Just where do you find value today? You know, you can define the period. Where would you, as you're looking out at the world, saying what's attractive?
Thank you for that kind introduction. And it's a very interesting time to be here today because exactly last year, this time at Milken, we were worried about China taking us to the brink of disaster. As you remember, we talked about that. And the world has changed a lot. And options in terms of sort of what's value are, some of them are things we were thinking about a year ago, some of them are very different. I think, as you were saying, there are really a few very interesting areas, I think, right now. One, obviously, I'm going to talk about a little bit more is emerging markets. The biggest inflows we've seen in emerging markets, 21 billion this year only into the equity markets, 26 billion into the debt markets. And obviously, growth rates in developed versus developing are very different. Whereas we have about 1.5% to 2.5% growth rates here. And in the rest of the developed world, in the emerging markets, you have more like a 4 to 6% with huge dispersion, obviously, and a lot of opportunities. So I think emerging markets, we talk about infrastructure, obviously, here in the US. Again, infrastructure in emerging markets as well will be very interesting. But I want to switch from emerging markets and just look also some very interesting areas here and look forward to learning from the other panelists. Private credit has become really interesting to us in the last year, 2 years. The reason for that is as we saw the huge regulatory change that took over American banks and European banks, but especially in the US, banks in some cases got out of the business of lending, which is really their business, and hopefully they will come back to that. But that created a lot of really interesting niche opportunities for private lending. And we have been looking at that really across the US, whether it's in aviation, in real estate, in other areas. And the rates of return are really, when you adjust for risk and when you adjust for liquidity, really very exciting. Other areas, again, I think some of the sessions this morning we heard, and look forward to hearing from you also, banks are sort of seem to be comfortable with the regulation we've got. I mean, obviously, they want some changes at the margin. You can tell us better.
It's feeling better. I wouldn't say comfortable yet, yeah.
But I think because you've invested so much in the regulatory apparatus and infrastructure, to dismantle that is also a big question mark. So I think a lot of interesting opportunities, but sort of switching back from that, community banks, which are sort of also adjusted to their new reality, have been a very, very interesting areas. So when we look at the world, I think we look at emerging markets. Within emerging markets, look at specific sectors, such as health and IT, which have grown a lot, but I think will be huge growth areas staying in the next 10 years. But then in the US, I think looking at less liquid options, such as private credit, would be very interesting.
Great. Thanks, Afsaneh. Let me go to Josh, speaking of alternatives and private, best ideas off the top.
Yeah, so first of all, you have to start with the environment, which is, the backdrop here is that we used to issue $6 trillion of securities in the world, net. And now the central banks buy more than $6 trillion. So we're now issuing negative $600 billion a year. So, North Korea, geopolitical things happen, bad news here, bad news there. Literally, you have an artificial market. And so anything that has a CUSIP that's publicly traded is in essence overvalued by a central bank bid. And so rates have come down, equity, and then that's driven rates across the curve down, and then it's driven equity prices up. And so we're a very treacherous environment, particularly when, certainly here in the US, you're in the 8th year of an expansion. We're getting long in the tooth, and so you have to be super careful. So with that as a backdrop, what we try to do is go to areas where there's kind of a need for capital and where there's a need for special expertise, and find arbitrages, find areas where for whatever reason they're not overvalued. And actually last year, in the midst of all this, we put about $10 billion out, which is our largest ever year in private equity. And I'd say the specific areas are, the first thing that's happening is the market is really getting barbelled between passive index funds and alternatives. And so the active management that you saw in the fixed income and the equity markets has been decimated. The hedge funds are under pressure. And so we're finding value in the public markets. For the first time, we've acquired 6 big public companies, ADT being the biggest. at very low prices. And so we're finding that, notwithstanding the high prices in the equity markets, that value is emerging. If you're an industry leader, if you're Facebook, Amazon, Netflix, or Google, if you haven't missed your earnings, your stock is trading at an astronomical multiple. But if you have any kind of a story, if there's any kind of an internet disintermediation threat, if you've missed your earnings, the public market just doesn't have time for you, and you can buy great fundamental companies. In our case, ADT would be the biggest example of it, largest brand in the security services market for very low multiple, for 5.5 times cash flow. So that's kind of one area. The second area, which was touched on, but I'll go into a little more expansion, is certainly we're finding a lot of value in Europe in the banking sector. So today, the U.S., and again, areas where there's pressure. And so today, the U.S., 19 trillion economy, 13, 14 trillion of banking assets. Europe, 40 trillion economy. 19 trillion economy, 40 trillion of banking assets. So there's still too much leverage in Europe. The regulators are still pushing down the size of the banks, and whether it's buying packages of non-performing loans from the banks, buying divisions, buying the banks themselves or the insurance companies. So whether it's buying credit from banks or buying businesses themselves, we're finding that once you're in the regulatory club, once you're approved by BaFin and the EC and the Spanish regulators and the Italian regulators, there's value there. And so we're able to buy securities and banks at 0.5, 0.6 times book value, and then facilitate a capital injection. Another area which we're finding is energy. Energy got decimated. Obviously, oil went from 100 to 30. Now it's back at 50. And so that sort of put a lot of pressure on these companies. They need a lot of capital. Certainly in the U.S., the best basins are still economic, even at 50. But they need capital, and so we're finding lots of opportunities privately to inject capital into energy companies. Interestingly, this is an area where the public markets never really adjusted appropriately. So we waited. We had a debt fund and an equity fund, and we waited for the public markets to go down, and they sort of stayed high. And so, again, going into off-the-run credit and off-the-run equity is kind of the way you combat, I think, the central banks, which have created this artificial market. And then last thing I'll touch on, which was mentioned, is this notion of private credit. And people talk about the decimation of some of the active fixed income managers, and BlackRock being the beneficiary. Certainly the alternative space, and Blackstone and Apollo being the two largest in that space, but there are others. We're seeing opportunities, whether it be direct origination in the middle market, whether it be coming up with other strategies like aircraft leasing, special servicing for non-performing loans, but going off the run and getting out of that firefight with the overvaluation by the central banks allows us to get somewhere between 100 and 400 or 500 basis points of arbitrage over the curve, and the curve is clearly overvalued. And so those would be some of the areas that we're finding.
Great, thanks, Josh. Tony, pick it up.
Well, first of all, I agree with everything Josh just said, and we're playing a lot of the same themes. But I would add a few things here.
It's always good to go first.
Number one, I think as a generalization, the more liquid a security, the more overvalued it is. And that's true across markets, it's true across asset classes, and so on and so forth. So obviously that pushes us where we're already is illiquidity anyway. But within that context, I would say, first of all, non-securities, we're buying a lot of hard assets. It could be real estate, it could be mineral rights, it could be spectrum, it could be leases, actual leases themselves under different things. So the market's very inefficient for those, and we're getting some, it could be life settlements, which is another thing that Apollo and Blackstone share. The very inefficient markets, very high unlevered returns on capital still available, and very few people have the expertise to play that. Secondly, interventions in companies or buildings. There's an awful lot of undermanaged assets now. The market's not pricing the improvements you can put into it. So if you have the ability to actually go and significantly intervene, I don't mean a little bit, I don't mean tweaking, significantly intervene in the cash flows of the business, that's always there. You just have to find it and have the expertise to do it. We've also brought duration into it. So you can get a lot richer actually putting $100 million into something and have it compound for 25 years at 12% than you can putting $100 million into something and have it compound at 20 for 5. And so if you can buy great assets, whether they be real estate assets or corporate assets that have a real moat around them and are really reliable, you can do very, very well over time. I also do think there's some values in emerging markets. They've lagged the markets for 10 years. And I don't think there'll be some good money to be made there. But I just add those things to what's been said already.
Thanks, Tony. Bjarne, I want to go to you now. So you've heard some perspective from the asset management broadly universe with regard to where value is. You run one of the largest, most sophisticated, most global pension funds in the world. Talk a little bit about how you think about returns generally, and then maybe how you're thinking about asset allocation and what's changed recently.
Sure. Let me say first that we are a long-term investor. So when we try to do asset allocation, even though macro and our outlook plays into that, I think it's fair to say that we have a longer-term, more risk-based, expectation-neutral approach to doing investments. And what do I mean by that? Well, probably mean to some extent that our ability to see the big trends and call when rates should be on a 10-year rise or decline, we're not very good at that. We lack the confidence that we're good at that. When I started as chief investment officer in ATP in '99, rates in Europe just came from 6% to 5.2 or something like that. And if you could ask everybody would say, well, they're pretty low now, they can only increase. And then here 20 years later almost, we have a 0% rates in Europe. So we're all wrong for 2 decades or something like that. So and you might be right, and there's very smart people out there, but when we do the portfolio construction, we try to create, like, the first part of it is really neutral from expectations, trying to look at risks and trying to diversify across different scenarios. Not only making sure that if 2008 happens again, that we'll be okay, that we have diversified our risk, but what if the 70s happened again, or if the 50s or the 40s or the 30s happen again? So trying to actually create a long-term portfolio based on a lot of historical crises and not expecting the next crisis to be the same one. So that actually leads you to a portfolio that is more diversified, and we have been looking over the last couple of years into our equity exposure, a lot of equity exposure in a lot of pension plans, trying to see whether we could find a way of harvesting risk premiums in the market without being too equity-centric. So really believing that if you invest in a lot of different assets, you will over time harvest a risk premium, whether it's credit, whether it's commodities, whether it's equity, whether it's tips or something like that, you would over time accumulate return. If you do not believe you have the crystal ball and you can forecast markets, then you try to diversify. So this is really the step one for us. And therefore, even though, if you ask me whether I think rates would go up or down, I would say certainly they would go up, but globally. But if you then ask me, are you sure then you should invest based on that expectations? That probably not. You should probably have some interest rate risk in your portfolio if you are wrong. So therefore, that's like the approach. We try to create a portfolio that will do okay in all scenarios. If risks are elevated, like you could say there now, even though people said that in '99 as well, the search for yield was what we were talking about then. It seems that as you're getting older, you continuously believe that it's more and more difficult to find value and everything is expensive. Andrew Claerhout, our head of infrastructure, and I discussed that recently, that infrastructure is a good example. We think it's expensive, but at the same time, we know that there is like trillions of dollars out there that wants to invest in infrastructure. So even though it is expensive from historical standards, will we continue to see money flowing into that, and will it continue to become more and more expensive? So that's like one thing. The other things we're doing then when we created that portfolio is really trying to figure out, should we be passive, active? We are going for more active because even though you have this approach, we allocate more money to our capital market department. They take market-based views. They are like internal kind of hedge funds. We allocate more money to our traditional equity long-only strategies as well. We think it's easier today because it's not so crowded anymore. So more active, less passive, that's a general theme as well. We believe that's where you can find the value. And then finally, I would say we go, even though we have a high percentage of illiquid assets, real estate, infrastructure, private capital, we increase our allocation. We are planning to increase our allocation to illiquids and probably decrease to the more passive liquid market. So I think value will be there. You will harvest value over time. We do not take these very strong macro views and change our allocation a lot, but we have a lot of people doing shorter-term directional-based strategies.
Can I just say, like, it's very hard right now because the traditional view, everything is fundamentally overvalued in terms of the true cash flow generation potential, but the central banks have figured out that they can sort of wash over any volatility in the market by just buying more and being more aggressive. And there's really no end. While the U.S. has paused, when you look at the world, and it's a connected world with Japan and with the EC and with a number of other countries, we're still adding a lot to the balance sheets. And so we could all be waiting a long, long time, right, for this rise in rates. And the traditional wisdom, I think I've been here 3 straight years, and I'm saying, well, rates are going to go up, rates are going to go up, rates are going to go up.
It's happening.
And the reality is they haven't gone up. They've gone down. And so, you know, I'd say that the only advice I think sort of trying to figure out how to navigate this market by getting out of that is probably the best advice that I can give. And if you have to be in that market, I think that certainly equities, the yield on equities at this point, the dividend yield, the earnings yield, the dividend yield on equities is close to the 10-year treasury in the U.S. That's so think about it, you get all the upside of owning a stock and you get the same cash flows of owning a bond. So I guess if you have to go into the market, I'd probably go into equities. And you know, but I think that it's very complicated and we all might be waiting a long time for that rate rise that we all know is coming fundamentally because it may never happen. And so just throw that out there.
You know, we have a couple of products that are based 100% on floating rate debt with a little leverage in it. We have a real mortgage REIT that does that, and we have a corporate credit, senior secured loans, only 100% floating rate. Put your money in there, 8%. If rates go up, you get more.
Yeah.
And it's all senior secured, all of it. I think that if you want to park some money for a while and wait for things to change, what a great place to put it. So you know, I also just want to make a plug too for the alternative asset industry. Just as well, I'm thinking about
our stocks are. Go ahead, man.
when we talk about, you know, you can buy our stocks and get an 8% yield too, and have long-term secular growth in the high single digits, and a lot of optionality on the upside, and not much optionality on the downside. So I think it's there, you know, plug for our little industry.
So I think we're all connected to alternatives in some regard, whether we're managing alternatives, servicing alternatives, or investing in alternatives. Bjarne, let me go back to you. And to the extent that you're investing in infrastructure and alternatives, what's your point of view, short and long term, about investing, co-investing, going direct? Talk a little bit about that.
I think it's fair to say that Ontario Teachers has for a long, long time developed a model where we invest directly in companies and with partners as well. So we do that in most areas. Mm-hmm. More and more strategic partnerships, less just deploying money to external managers, but we still need partners, and we're not going to decrease the amount of money that is managed externally. But it has changed, I guess, the character of the relationships between people that we actually want to sit down and have a strategic discussion with, mm-hmm. and not just passive money deployment. We have built, I think it's last year we had our 25th anniversary for our private capital team. They have been investing in direct deals, controlled deals as well, not only with GPs and as co-investment, but actually directly as well since the beginning of the 90s. And the result has been pretty okay. So we truly believe in that model, building operational in-house skill sets and then having strategic partners you can do that with. And that's probably something in real estate. We have a company, Cadillac Fairview, ourselves. They have operational skills. They have development team. They have 1,400 people working in the real estate industry. So that having depth in your knowledge and actually being involved with partners and then having people in-house that can actually do direct investment as well. I think that's the key, and that's something we plan on continuing doing.
Let me, another common theme that came up is real estate and infrastructure as a theme. And you know, if you think about just in this country, the promise of a fiscal spending bill and upwards of $1 trillion going into you know, infrastructure investment. Tony, let me start with you. First off, you know, how do you do it? Where have you seen it in other parts of the world, the private-public aspect of infrastructure? Any counsel for our current administration on how we go at it? And then I'd like to get into a little bit, you know, differences in real estate and what's attractive and what isn't.
Well, okay, so let's separate the two. I think they're very different. But focus on infrastructure. This country needs a lot of infrastructure spending. It needs a lot of new building. But the public-private partnerships have been very, very difficult. The regulatory cycle is a decade long, and if you have expensive money that compounds at high rates, it's very hard to earn the returns. You're, in a sense, you tend to piggyback off municipalities and whatnot at a very low cost, investment grade. Tax-exempt financing is hard to be competitive. So if you look at the PPPs that have been done, the equity checks are small, they're very labor intensive, and they take a long, long time. So it's not a very investable asset class if you're not one of the construction companies that's paying for it out of their construction margin. So if the administration wants to get the infrastructure going, they're going to have to break that loop a little bit. And I think it's always going to be hard for private sector to build public infrastructure in this country for some of those and other reasons. But if the government, and the government's not going to have enough money to really do what we need doing, but if they facilitated the redeployment of now state-owned assets to put the private sector, and then the states recycled that money into building, I think that's where the big volume could be. And the way to facilitate that would be if New York State sells the Tappan Zee Bridge, for example, for $2 billion, they get 25% extra from the federal government to redeploy $2.5 billion into new building infrastructure. They're going to need to do something like that. That will prime the pump, and you've seen that kind of ability of other countries to build, sell infrastructure, and then redeploy the assets. I think we're going to need to do that, and we're going to need to have an infrastructure czar of some sort that takes that 10-year approval cycle down to the 2 years that are present in Canada and some of the other countries that do this well. But you've got to do those two things.
And real estate, you're going to separate that?
Well, real estate's a whole other world. I think real estate's just a great business because they're hard assets. We buy assets and we never pay more than physical replacement cost. And so you've always, and if you buy them in good markets and you're not taking a lot of market speculation, we're not doing it in Uganda and places like that, or even Detroit, it's very, very hard to lose money. Yet, you could go and improve the assets, and the financing's very cheap. The financing's always available. The assets are easy to improve because the only way they get undermanaged really is undercapitalized. And so the combination of that is very powerful. So you can have private equity type returns with AA debt kinds of loss rates. And there's no other asset class that has a better risk-reward balance, in my opinion. And it's global. There's more value of real estate out there than all stocks and bonds combined by a lot. Yet the capital chasing real estate is much smaller than, say, private equity. And because it's not securitized and not regulated, you don't have the same equality of information. So if you're the biggest buyer and the biggest owner, you have information advantages that are very, very substantial over anyone else. And when you compound all of that together, I think it's a very powerful asset class. And we're seeing just great values still in Europe, in India, in Japan, believe it or not, places that you think assets are really overvalued, and but they're, you know, they're always. So I'm a big fan of real estate.
Let me press on something for a minute. In the commercial realm, the gig economy, call it what you will, more people working from home. The most recent building we put up, we moved from and to. We went from 210 square foot a person to 108. Half the people are working from home. When I look at these long-term trends about how work will be done, how do you factor something like that into a real estate thought?
Well, the amount of office space per employee has been on a steady decline for 35 years, and it's down 40%. So it's not new, and you factor that in. But you bet on certain trends. We bet on urbanization, continuing urbanization, and it doesn't necessarily mean Manhattan. It could be small cities like Bozeman, Montana, but urbanization. We bet on e-commerce, the last mile distribution. It's very hard to build last mile warehouses in dense areas. No country, I mean Japan, for as modern a country is, China, no country has an efficient, modern distribution system for e-commerce. So those are just mega trends that are kind of easy to identify, easy to play. Would we buy, and there's always, would we buy a retail mall?
Yeah.
No. We look at the barriers to entry, but this country hasn't for 15 years replaced its obsolescence of its commercial real estate stock. There is obsolescence to commercial real estate, and we haven't been replacing it. So I think it's as analyzable as anything, and much more stable and slower moving than corporate fortunes.
Great.
On the infrastructure, I just wanted to jump in. The last 2 weeks was the World Bank IMF spring meeting, so everything was on infrastructure, every single meeting. And I think quite a few meetings today and tomorrow here will be on infrastructure. I think, as Tony said, the biggest issue is that you take anything from 1 to 10 years to study, someone has to pay for that. It's not just the time, but someone has to pay for that. Then you have to build the infrastructure. Again, somebody has to pay for that. Then it takes another 5 years, maybe 10 years, for it to sort of get mature and actually make money. So all of these lead times can add up, which is the big issue with infrastructure. So one is the total amount of financing. 2 is sort of the timing of when the financing comes in. And obviously a lot has been done in financing of emerging market infrastructure has been a more robust area than in the developed world. But some lessons on the PPP learned there that we could bring back here. And I think the other thing is sort of the AI issue, and how will that affect real estate and what Tony was talking about in terms of needs, and that could be even a bigger impact than labor shifts. But last but not least, in the emerging markets, again, the cities are going to be very important. Urbanization has increased hugely in these countries. So if we look in a decade, probably of the 50 mega cities, 42 will be in emerging markets. Some will be cities that nobody here has ever heard about. So if that is happening, the infrastructure needs of those cities, the clean air, all the things that go with it will be very interesting.
On infrastructure, we need revenues. There's plenty of financing, but there's just not a lot of revenues in the U.S. There's a few bridges, there's some highways, there's an airport or two, but we don't have revenues. And so I think ultimately the country's going to have to come. This is a huge. I mean, we've been studying for a while. It's literally the rerouting of your air travel, the congestion. We're now, the competitiveness of the U.S. is starting to decline, so we're going to need to make some hard choices. I think that the easy way to pay, I think that, I'm going to say a word that makes politicians shudder: gas tax. 50, if all we had done is kept pay, in 20 plus years ago, we decided we weren't going to keep pace with inflation here in the U.S. That's $50 billion in revenues that's gone away. Another word, Amazon has had a free lunch. E-commerce is not taxed. Retail mall sales are taxed. So that's $25 billion in revenues. If you just did those two things, you'd end up with $75 billion of revenues that, you know, in essence pays for $1 trillion of infrastructure over time. So I think there's, unfortunately, you're at the point where we have to do something for the country, and we're going to have to, you know, start to socialize some of the harder choices. And it's not, the financing is there, but it's really about, you know, all the things that have been discussed and ultimately like creating revenues around these sources.
Sean?
Yeah, I just wanted to add to some of the comment from Afsaneh about it takes time to invest in infrastructure, and it takes time to build a regulatory, setup in the US, as in Canada, as in other countries. It's doable. You can see the UK has built a very strong regulatory setup over decades, and it works well, and people are comfortable about most infrastructure investments. They're actually in teaches 52% of our infrastructure globally is in Europe, a lot of it in the UK. A lot of investments in Chile, and we would of course like to be able to do more in the US and Canada as well. So we hope that will open up. But my comment was really on greenfield, and even though we do that as well, and we look into it, I think platform investments having operational and development skill sets. That's true in our real estate as well, but in infrastructure we have an airport subsidiary in London, people with their operational experience from airports actually. We own 5 European airports. And what we can see there, sometimes it's much better to own an airport and figure out what kind of investments and capex do you need to do in that airport to increase traffic. That's much easier sometimes to chase the next airport and the next one and buying new stuff. So that is something that's really interesting with infrastructure. If you get the right assets and you build a platform, you can actually increase your return significantly by having the right team on ground there to focus on capex and operations.
15 federal agencies and up to 50 state agencies have to approve a bridge. So
Yes.
when you start to understand, you know, the process, and you know that's why it can take up to 15 years, and they all have different requirements. So there's a whole, you know, re-engineering project that's kind of underway, and I think the administration actually gets this and is really focused on it and on top of it.
Great.
You know, there's a lot of focus in this conference, I guess, because of all the cabinet members and whatnot on U.S. infrastructure. Mm-hmm. But I think it's if the single highest performing asset class we have is emerging markets infrastructure. Yep. So we've put over $7 billion to work there in the last 5 years, and the returns on that $7 billion has been 47%. Compounded annually. So we shouldn't lose, if this is about value, we shouldn't lose sight of the fact for people in the room of building emerging markets infrastructure can be an extremely attractive asset class. You got to have a lot of very specific skills and domain knowledge. It's not really an investable asset class if you're just a financial investor, but it's been our best single place to put money.
So Tony, let me, it's a good cue, and Afsaneh, I'm going to ask you, you began the discussion with some commentary about emerging markets, something you're deeply knowledgeable about. Emerging markets is driving half of the global economy today, growing at twice the rate of developed markets. You know, there's I'd say hope, maybe a little bit more than hope, that the developed markets are on a better trajectory. But the dependence on emerging markets is as great as it's ever been. And emerging markets is a big subject. Break it down a little bit. What, you know, and you know, the question about, you know, is there a correlation between GDP growth and attractive investments? And give us a little bit more detail on what markets you think are in favor and out of favor.
So emerging markets was a term, I think, that one of my old colleagues at the IFC sort of termed, and then there have been other terms that have been created ever since. So, so I think, agreed, you know, there's a lot of dispersion between these countries. China is the second largest economy, and so to put all of these countries together may not necessarily make sense. But in terms of sort of looking at the future, obviously, GDP growth rate and your investment doing well do not always go hand in hand here or in emerging markets. However, if we look at emerging markets, the thing that we heard, you know, when Tony talks about infrastructure being really interesting is partly because when you look, the largest amount of GDP growth, more than 75% of future decades, GDP growth will be in emerging markets broadly defined. If we look at the growth of cities, as I mentioned, it will be there. If we look at growth of energy, it will be, again, not the stock, but the growth rates, the marginal growth rates. If we look at airports and freight. The largest number of new airports getting created, and the largest number of and the freight growth will be in emerging markets. And we are sort of used to thinking that trade is something which is between developed countries and emerging markets. And I think some of the dialogue in the recent past has sort of made that even more seeming like that's the important area of trade. But really, if you look now within these emerging markets, it's regional trade that is really important. Japan, Guangzhou, they had an increase of 12% in 1 year of trade between the one region of China and the country. Singapore has all these knowledge universities they're creating where they're doing more innovation in the region. So I think what is going on, which is less obvious when we look at total data, is that it hides the fact that some countries are growing faster than others. Some are investing, like China, in cleaner energy because you can't breathe the air in Beijing, you can't breathe the air in Delhi. The Chinese are putting 100 billion a year. The Indians are putting 10 billion a year. So these are huge changes. Also, these emerging markets, it so happens we've got Alan Greenspan as a senior advisor, sits with us, and so we talk a lot. And his big topic that he talks to me a lot about is entitlements. We have an entitlement, which is about 15% of our budget here. In emerging markets, it's a much, much smaller scale. So when you look at everything, they're starting with a smaller base in everything, which means you can grow faster. I always like to use the case of health sector. If health sector is almost 2% of total MSCI, and it doubles, it will go to 4%. It's still far below where it needs to go, which makes it very interesting. In our country, we're closer to 17, 18%, depending on when you look at it. So again, looking both to the totality of emerging markets in terms of the trends we see, but then breaking it down into sectors, I think, is very interesting. And then really looking, I think, at any of these countries. Africa has been a terrible place to invest. The last few years, markets are down close to 20%. Eastern Europe has not done very well. But the question is, within that same situation, you could find great companies. So you really have to look for intrinsic value. And I think one of the things that we have learned sort of the hard way is you have to get to know those companies, and having people sort of with boots on the ground who know the operations, as Bjarne was saying, but also know what is a fraud and what is a really good company is really, really important in this country. And these countries, and that's much more valuable than here, where you have a better regulatory structure to protect you.
Can I say, we have not found GDP growth, the excess GDP growth correlating with value or return in the emerging markets. And I would say that certainly with the dollar having been up 15% since 2014, emerging markets are cheap. I think it's wildly tricky. I think that there are corruption issues, there's transparency issues, there's currency and central bank easing issues. So I think that it's really not for the faint of heart. And by and large, I'm not sure that, certainly for the stuff that we do, it's a place where we put some money, but not a lot of money. I think that certainly Brazil and some of the South American economies and currencies are so beaten down at this point that they kind of look interesting. But I would say that I think that it is over. You have to be the success of managers in this area has been low, and so it's an environment to be careful of.
Yeah, let me just. I completely agree with that, and I find particularly the corporate side hard, but there are ways to protect yourself against that. So, for example, buying the best building in a difficult emerging market, but where Nestle is on the hook for the lease and you've got their corporate credit on it, but you're also paying a fraction of replacement cost. If the market goes, you get the upside, but you've obviously got in a global company. So we like that kind of play. Similarly, with some of the infrastructure stuff we've built, they're so necessary for the country that you're not so subject anymore to political wills. And the political winds, and we've been able to get OPIC and some other things like that, protecting against the sovereign risk. In general, buying corporate securities in emerging markets, I completely agree with Josh. First of all, it's tricky. Secondly, things change. What looks like good, even great management that's honest, it changes, and then what you're left with. And it's like the Roach Motel. It's much easier to get in than to get out of these things. The exit markets are very limited, and people look at intrinsic value. I'm getting a great buy, but then when they try to come out, there's no bid. So I think it's tricky, but I think that's why there's so many good opportunities if you have real expertise and if you're smart about getting an anchor on hard assets or dollar-based revenue streams. Another big thing, because that way, if the currency melts down, your margins go up, right? And so we've done very well in Brazil with dollar-based revenue streams.
The alternative space, by and large, I mean, I'm generalizing, it's a fraction of what we do. I mean, in our case, we're probably on the low side. It's 3 or 4% of what we do. It's not zero. I mean, there are idiosyncratic opportunities. And the dollar adjust, if you're a dollar-based investor, right, the dollar-adjusted returns have been, the dollar risk-adjusted returns have been poor over time in the public markets. And so I think it's a pro-cyclical play. Certainly at this part of the cycle, when everything is looking good, you could, experience some volatility to the upside, but it's, as I said, it's not for the faint of heart.
And in our case, I don't know exactly how much emerging markets, but non-U.S. is 50% of what we do.
Yeah.
No.
We're 30.
I don't know whether I can change the topic a little bit.
Sure.
One thing, a theme that we are very focused on, and I think is going to drive a lot of value, is the changed regulation in banks.
Yes.
And when we're looking for investment opportunities, I guess we have to separate the risk we're looking for and the return on risk, and then the leverage it comes with, because you see that the reliance institutional investors like us have had on repo financing in banks. Sure. With the way it's being priced globally, this time means that we have to think differently. At the same time, as I said before, we're looking for a more diversified portfolio. That really means that you need more leverage to get to the same kind of returns if you have less equity-like. So that transformation about how you make sure you can find the right investment products, the right things out there where you can get the right return, the right risk, without relying on that banks will be there with inexpensive repo financing for institutional investors. That's really one thing we have focused a lot on. We have started up a CP program and are now close to issuing medium-term notes as well, to make sure that we're not only dependent on repos from the bank. So that whole area and how that affects different areas of the investment world, I think it's fair to say that when we have discussion with people that manage money for us, the way they structure their investments, and you can do you get the same kind of product with a 10% volatility or an 18% volatility, and that part. So that's actually something I think is going to be more and more in focus with the changes in behavior from banks.
And I think it's hard for any of us to know where bank regulation is going. And I think the U.S. and Europe are in very different places. I think the U.S. tightened down hard, increased capital liquidity requirements, resolution recovery. Europe has taken a soft approach. I think probably both need to moderate. But it's also true that, and I'm sure you'll validate this, that the quote, credit out of the banking system, some refer to it as shadow banking, is far more advanced in the U.S. than it is in Europe. And I suspect part of that is the crackdown or the more significant regulation that's been imposed on banks. I'm not sure, two things. One, I'm not sure where we go back to with regard to regulatory balance in this country, although I suspect that it'll feel a little bit different as time goes on. But I don't think that you go back to a world where the banks are the extenders of credit in this market. I think the door's been opened. Private capital going direct is likely to continue to be there for a long time. Europe, a little less certain. I suspect that before Europe gets through this cycle, they're going to have to put more capital into the banks. And so maybe that opens up the opportunity, credit opportunities in Europe, which haven't been here up till now because the regulatory environment has been a little bit more favorable towards banks extending credit.
Look, the banks are the biggest players in the market. They're $100 trillion. So to put it in context, if you add up the top 7 alternatives players, it's a half a trillion.
Yeah.
So literally, and the U.S. has decided that the banks are utilities, that they shouldn't be pricing and taking risk. In Europe, banks are just too big. You know, UBS and CSFB are still multiples the size of Switzerland, and you know, I could repeat that, you know, for different countries. So I think that the fact that the U.S. regulatory environment will get a little easier. Having said that, the opportunity for firms like Blackstone and Apollo and other alternative providers, and you know, the larger and smarter big pools of money, such as you know, Ontario Teachers and others, is going to be to disintermediate the banking sector. And when I talk about off-the-run credit being a 1 to 300 basis point arbitrage, what I'm really saying is that these are areas where the banks are pulling back, and as they pull back, you know, there's these arbitrages to be had in the market. And so capturing those arbitrage with the special expertise that you can garner is what you need to do. I can't tell you how many teams are coming from Deutsche Bank and CSFB and, you know, 2 places like Apollo and Blackstone, and also some of our investors, you know, are getting into it as well as we try to provide the credit that the banks used to provide. And even if the regulatory environment gets easier, I think it's kind of over. I think it's going to keep going that direction.
Yeah, I'll just note a couple of things. First of all, I think it's a mistake to think that the shadow banking is a function of the regulatory environment in the U.S. The U.S. always had a wildly more developed market for securities and loans and things like that than the European banks. And the weakness of the European banks is they never did develop the markets to be able to distribute risk, so they owned the risk. They still own it. They've been slow to respond, and that's driving a lot of the opportunities that Apollo and Blackstone are doing with direct lending in Europe, with frankly forced sales of real estate, a lack of financing for development of real estate, which is keeping values up, et cetera, et cetera, et cetera. Sales of non-performing loans, all that stuff is better in Europe than here because of the weakness of the banking system. The bank CEOs I talk to, and I've recently done a little, kind of spent some time with them, they're talking about, in response to Trump, you know, are they going to do much different with this new administration and the new view on regulations? The answer is no so far. They kind of view this I'm not sure they know that this administration will necessarily be in power for beyond 4 years. So, you know, it was a very painful 8 years to set up the risk systems and the new way of approaching business. They're going to assume it's going to go back. And a lot of them will say, truthfully, we are a safer system.
Sure.
And we're better, actually. We're more careful, we're better, we have better controls, and we're not going back to that. So I'm not sure how much rollback you're going to get because they can't change their business models.
Let me just jump in
Completely
because
agree with that, I think. Yeah.
because we were deemed systemically important. We got caught up in the 8 year ago designation and all the regulation that's followed. If you look at the architecture of regulation, capital, liquidity, and resolution recovery, who can argue with that? If you look at what we were before the crisis, what we are now, who can argue with that? Having said that, the application of the rules has been overdone by some amount.
Oh, and the tone is radically different. It used to be you talk to a regulator, they come in, how can I get you? How can I find you? You know, I don't suspect any. We had one consumer products company where the CFPB, whatever it is, accused us of discriminating on loans because they looked at first names of a lot of the borrowers, and they thought there were a lot of first names of people that were probably African Americans, and on average they were paying more. And no rationale looking at first names of borrowers. We don't even touch those borrowers, by the way. We're buying wholesale loans from auto dealers. So, but it was so excessive when they call you and say, we're just gonna come in and we're gonna read all your emails for the last year. We're not looking for anything. We just want to read every email you sent or received from anyone in the last year. And it's almost became a feeling of a police state. It wasn't an impartial referee is important to any game. And I'm all for regulation that's impartial, making sure that both sides, buyers, sellers, play by the rules. But when the referee's trying to tilt the game heavily one way, it gets way out of whack. And so just that tonal difference will make a big difference.
I agree with the tone, and one final point on that for me would be, you know, you don't change as much as we've changed in the last 8 years without getting some of it wrong. So you look at some of the anomalies, if you look at the liquidity in the fixed income market, look at all the things that we've changed, it's really time to pause, change our tone, and figure out how we refine the things we put in place, not roll them back. We've got a few minutes left, and I just want to get the creative juices flowing here a little bit between the four panelists. And I'd like to ask you each a final question. And that question is, what is one headline you'd like to read this year? If we were here a year from now, you said, geez, what is that one headline that would change things for you? Bjarne?
The one headline, like a global one or a company-specific one?
Global.
A global one. What would that be? I would like to see a headline saying, well, everything globally seems normal and every asset class provides stable returns.
That's not fair. Afsaneh, what would be profound in your opinion?
And maybe it's living in Washington right now. I think what we're most worried about is not sort of some of the extremes we talked about earlier, like Syria or others. It's really North Korea and sort of the rhetoric that is going on between China, US, and North Korea and everything around it. And that is sort of a huge concern just because of the uncertainty and unpredictability around it. So I think if we woke up and heard that had been resolved one way or another, that would be really good news.
I was going to say nuclear disarmament of North Korea, but then I got two others. Apollo stock hits 50. Sixers win the championship.
I'm going to ask you to probability weight those.
I'll go there.
You know, this is a business setting, so I know you want a business answer, but there's all kinds of things we'd all love to read, like cancer's cured, global warming goes the other way, literacy rates in the U.S., students go way up, on and on. I won't go over all that stuff. I guess it's summarized to me, all these are good points, but it's summarized to me if the Dow hits 40,000.
There you go. Okay.
I like that one.
So for me, it's a little technical, but I struggle sometimes when I look at this economic malaise that we're in, and I look at digitization and technology and all of the things that we're doing to get better, and I look at the productivity numbers in the developed markets, and I scratch my head. I say, how could that be that we're replacing labor with technology, we're getting more efficient, we're working the expense line. So my headline would be, we finally see an upturn in productivity in the developed markets. I think that would signal growth and a lot of good things for all of us. I'd like to thank you all and ask you to put your hands together and thank the panelists.